China didn't just make a move, it rewired the global system. While Trump slapped tariffs, Beijing signed the biggest trade pact on Earth, $25 trillion in GDP, 2 billion people, no US signature, Gulf oil's ditching the dollar, Southeast Asia runs on Chinese code, and the West locked out. This isn't BRICS. It's bigger, it's faster, and it's already live. If you think America still runs global trade, you missed what just detonated in Kuala Lumpur. China didn't just attend the Kuala Lumpur summit, it orchestrated a $25 trillion alliance across ASEAN, the Gulf, and its own industrial network, while the US was preoccupied with 50% tariff hikes. This coalition now controls over 2.15 billion people and a GDP nearly equal to the US and EU combined, yet received almost no mention in mainstream Western outlets. According to Bloomberg, ASEAN's intra-bloc trade rose 9.4% year-on-a-day lekis in the first quarter of 2025, and its exports to the Gulf jumped 13%, signaling a silent reorientation. Malaysia's Prime Minister Anwar Ibrahim called it a platform of convergence, not confrontation, but the absence of Washington at the table was not accidental. Former Malaysian Ambassador Muhammad Nazri told Reuters this summit showed China is filling the vacuum left by Western tariff threats, not through conflict, but coordination. So if the map's being redrawn, why hasn't anyone in the West noticed? According to IMF figures cited by the Wall Street Journal, China, ASEAN, and the Gulf Bloc now contribute over 55% of global GDP growth, making that's them the largest collective growth engine in the world. ASEAN-China trade surpassed $982 billion in 2024, while GCC-ASEAN trade surged to $63 billion, up 60% from pre-pandemic levels. Vietnam's steel exports to the US plunged 27% this year after Trump's tariff spike, yet its imports from China grew 14%. A quiet pivot, now replicated across the region. In Indonesia, US tariffs erased 5 years of surplus gains in a single quarter. Meanwhile, China's ACFTA 3.0 rollout includes digital trade, ESG standards, and green energy initiatives, areas where US engagement has been limited or reactive. James Chin of the University of Tasmania put it bluntly, China is being given a platform where the US isn't even in the room. But what happens when China's trade corridors stop looking regional and start looking irreversible? When the ASEAN Express freight line from Malaysia to Chongqing launched late last year, it didn't just reduce logistics costs by 17%. It redefined who controls Southeast Asia's industrial arteries. The Jakarta-Bandung high-speed rail, co-enhanced by China at $7.3 billion, has already carried 9.2 million passengers, per data from Indonesia's Ministry of Transport. These aren't just infrastructure projects, they're commitments sealed in steel. By embedding itself into ASEAN supply chain, China transforms regional partnerships into dependencies. And it's not one-way traffic. Chinese firms are offshoring production to lower-cost ASEAN hubs, deepening integration while dodging US sanctions. The Wall Street Journal reported that Chinese green tech exports to ASEAN climbed 19% in the last 2 quarters, driven by joint factory zones. But the real acceleration that's happening where no one is watching, undersea cables, AI data centers, and 5G backbones, all flowing east. So what exactly is Washington building right now other than resentment? Let's take a breath, because what happened in the Gulf used to be unthinkable. Saudi Arabia now executes 30% of its oil sales in non-dollar currencies, according to Bloomberg Energy. And the GCC just pledged to raise ASEAN trade from $130 billion in 2023 to $180 billion by 2032, led by Crown Prince Sheikh Sabah Khaled's new investment charter. Simultaneously, Chinese Premier Li Qiang confirmed Beijing would align development strategies with Gulf and ASEAN priorities, signaling a shift from bilateral deals to trilateral ecosystem. Meanwhile, TotalEnergies inked a yuan-based LNG contract with China, breaking the petrodollar monopoly that's existed since the 1970s. So, while Western analysts debate if the Gulf is drifting, China's already docking. The Financial Times notes, Gulf sovereign wealth funds are funneling capital into AI, green energy, and digital finance, all areas where US investment has stalled. But if China now controls the trade lanes and the fuel supply, what's left for the US to leverage? Despite public claims of winning on trade, the US has signed 0 formal binding trade agreements under Trump's second term. The Phase 1 deal with China, never ratified by Congress, has seen China miss agricultural purchase targets by over 28%, with no enforcement penalties. The Peterson Institute reported US tariffs have cost the economy more than $300 billion since 2018, while failing to reshore industrial capacity at scale. In contrast, China is spearheading legally binding multi-sector frameworks, RCP, ACFTA 3.0, and the upcoming GCC-China Free Trade Agreement expected by mid-2026. Even Canada and Mexico, once cornerstones of US regional trade, are diversifying toward China and ASEAN markets, with Canada's FDI and Asia growing 11% last year, according to IMF data. As Washington relies on executive orders, Beijing builds permanent architecture. So ask yourself, who's truly decoupling and who's just being left out? In 2025, Chinese tech giants aren't just selling hardware, they're building digital jurisdictions. Huawei now controls core 5G infrastructure across Thailand, while joint AI labs in Singapore and Malaysia are backed by China's National Development and Reform Commission. According to Bloomberg, China's digital investment in ASEAN rose 28% in 2024, primarily in cloud computing, AI, and fiber optic networks. These aren't simple exports, they're system-level partnerships locked in through 10 to 15-year tech leases, many tied to sovereign data access agreements. Washington's semiconductor bans forced Chinese AI firms to pivot their compute bases to Southeast Asia, triggering a 36% surge in Chinese-funded data center construction across the region, per CBRE. These centers aren't just bypassing US restrictions, they're embedding China into the back end of ASEAN economies. So when the next digital currency logistics platform or smart grid goes online, will it even need Western integration? In March 2025, China and TotalEnergies executed a liquefied natural gas trade in yuan, bypassing the dollar entirely, the first of its kind. And it wasn't just symbolic. That transaction actually laid the groundwork for what Bloomberg now estimates could become 20% of global energy contracts being de-dollarized by 2028 if current trends hold. Saudi Arabia has already moved 30% of its oil contracts off the dollar, and the UAE now clears UAN in bilateral trade with China's CIS system, effectively insulating deals from swift oversight. Meanwhile, China's Belt and Road-linked energy corridors, including digital oil payment systems in Indonesia and AI-managed pipelines in Kazakhstan, are linking hydrocarbons to fintech in a way the petrodollar system never anticipated. According to HSBC Global Research, UN usage and global trade settlements has risen from 2.5% in 2020 to 58% in the first quarter of 2025, which is a more than doubling in just 5 years. But honestly, the bigger shift isn't currency, it's control. If energy no longer flows through the dollar, who controls the current? The Kuala Lumpur summit didn't end with a defense pact, it ended with a blueprint. ASEAN, the GCC, and China agreed to accelerate a GCC-China Free Trade Agreement while upgrading ACFTA to version 30, integrating ESG metrics and AI regulation frameworks. According to Anari Brahm, this tripartite alignment now holds $24.87 trillion in GDP, comparable to the US and EU combined. But beyond GDP, it's setting legal templates. The proposed GCC-funded maritime corridor in East Malaysia will bypass both the Strait of Hormuz and US-controlled Pacific choke points, forming a third axis of trade. Professor James Chin called it a model of ASEAN cooperation, where legal interoperability replaces military guarantees. Former Ambassador Mohammed Nasri added that China is filling the global governance vacuum with contracts, not speeches. So, if ASEAN, the Gulf, and China can standardize trade law, tech governance, and investment arbitration, who still needs WTO-style arbitration to settle disputes? Vision 2045. ASEAN's strategic roadmap, unveiled at the summit, sets targets for digital economy integration, legal harmonization, and industrial cooperation zones. But execution remains the biggest variable. According to McKinsey, intra-ASEAN trade still sits at just 23%, far below the EU's 65%, largely due to customs inconsistencies and fragmented digital infrastructure. ASEAN's strategic roadmap, unveiled at the summit, sets targets for digital economy integration, legal harmonization, and industrial cooperation zones. But execution remains the biggest variable. According to McKinsey, intra-ASEAN trade still sits at just 23%, far below the EU's 65%, largely due to customs inconsistencies and fragmented digital infrastructure.